2023 was the slowest year in our housing market in nearly 30 years. That's according to new data, which says that in 2023, in the United States, there were just over 4 million homes that were sold. Now, what does that mean? Well, to put that in perspective, that means that there were more homes sold in 2020 during a pandemic than there were sold in 2023. And that also means that there were more homes sold in 2008 during the housing market crash than were sold in 2023. Now, obviously, people were affected by this. Some of the most obvious were people like realtors who closed less deals, and mortgage bankers who closed less deals, and title insurance companies who closed less deals. But this also impacted people who wanted to buy and sell a home, because if you wanted to buy a home, well, you were kind of stuck, because not only are home prices so much more expensive today than they were just a few years ago, but now you also have to pay the higher mortgage costs because mortgage rates have gone up so much in the last couple of years. And if you're a seller, well, this is actually the good news for you, because if you're a seller, there's not that many homes available for sale. So you have less sellers to compete against, which means you get to keep your home prices inflated and sell your home for more money because, well, even though housing affordability is much less because now you have higher home prices and higher mortgage rates, you have the benefit of not having to compete against other sellers. So if buyers want to buy your home, they got to pay the price. Otherwise, they can take a hike. And this has been creating a lot of confusion and kind of question as to what this is going to mean in 2024, because a lot of people have been holding their breath, wondering what's going to happen in 2024. Are we finally going to see relief in the mortgage market? Are we finally going to see mortgage rates fall? Are we finally going to see more homes available for sale? And are we finally going to see more affordability in the housing market? So let's talk about what's going on there. By the way, there's a couple things I want you to know. The reason why there's a different background is because I'm in Tennessee right now, and I'm hosting a 2024 wealth building workshop. It's my first time holding one of these wealth building workshops. It's on February 6th. I have 2 times, one morning time and one evening time where I'm going to be doing this. It's completely live and it's completely free, where I'm going to be going over strategies and systems that you can start using to start planning and building your wealth for 2024 and beyond. So if you'd like to join me on this wealth building workshop in 2024 live for free, I got the link to how you can register for this workshop down in the description below. So let's jump into what's going on with the housing market in 2024. Starting with inventory, because inventory has been a big issue with the housing market for a long time. One reason that we've been seeing a low inventory of homes has been because of mortgage rates. Now, there's a couple things that mortgage rates are doing to impact inventory, because in the last 2 years, we've seen mortgage rates go from some of the lowest rates ever to now some of the highest rates we've seen in a couple of decades. And what that means is, number one, if you are a buyer, you want to go out and buy a home, that $500,000 home is going to cost you a whole lot more today than it would have 18 to 24 months ago, because now you're going to be paying 7% on your mortgage as opposed to 3% on your mortgage. So now your payments are going to cost you thousands of dollars extra a month, even though you're buying the same price home, just because your mortgage rates are more expensive. But the second reason why mortgage rates are impacting inventory is because now if you own a home and you're thinking about selling, you also have to think about the next home that you're going to buy. Because if you own a home, and let's assume that you bought your home in the late 2010s. Well, what probably happened was you refinanced in the 2020 pandemic era because you were able to refinance your loan at some of the lowest mortgage rates ever. So whether you bought your home before the pandemic or you bought your home during the pandemic, pretty much anybody who bought their home from 2022 and before, you were able to get or secure or re-secure a much lower mortgage rate. So now this is the bulk of homeowners out there today. And now you have to think that if you go out and sell your home, you're going to want to buy a new home, which means that if you go out and buy a new home, you're going to have to get a new mortgage. And if you have to get a new mortgage, you might have to go from a 3.5% or 3% or maybe 2.5% mortgage to a 6.5% or 7% mortgage today. That means you're going to have to pay a lot more money, and that might mean you can't buy the same size house. And that has been a big kind of deterrent for home sellers from wanting to sell their homes, because they just don't want to have to go out and buy a new home, because that's going to cost them way more money. So it's been creating a lot of kind of issues, because on the demand side, demand has been less, although we still have high demand relative to supply. People still want to buy homes, but demand has been less because people don't afford or want to pay this 6.5% or 7% mortgage. And then on the supply side, people don't want to sell their homes because they don't want to go from a 3% mortgage to a 7% mortgage. That means, well, people are kind of confused as to what to do, and that has been keeping home prices inflated. Then in addition to that, the builders have also been kind of concerned about the housing market. Now, this building issue has been kind of a really interesting issue in 2023. And the reason why is because we've been seeing periods where builder confidence is very strong and they start building very quickly, and then builder confidence can fall very fast as well. So you can kind of see this confusion between builders, because if you go out to build a neighborhood or an apartment complex, it's going to take you 12 to 24 months before that subdivision or that apartment complex is going to be complete. And that means you have to be able to project what is the economy and the housing market going to be like in the next 12 to 24 months. And if you're unsure if people are going to be able to afford the same prices as today, that can be a big deterrent for you wanting to go out and build new properties. Because if you as a builder are worried the home prices might fall by 3% in the next 12 to 24 months, that means you're going to pay $200,000 to build each unit today, but you're not going to be able to sell it for $250,000 like you're expecting. You might only be able to sell it for $240,000, which means you're going to have smaller profits in the future if people are worried about home prices falling. That's a concern for builders. Not to mention the fact that builders are also concerned about what's going to be happening with mortgage rates, which brings me to the question of where are mortgage rates going to go? Now, the way that mortgage rates affect the housing market is pretty straightforward. Higher mortgage rates kind of slow down the housing market. Lower mortgage rates create more boom in the housing market. Why? Because higher mortgage rates mean that you as a buyer have to pay more money to buy a home, and that lowers demand, and that also can impact supply, because if you're a homeowner, you don't want to go out, sell your home, and they have to get a much higher mortgage rate. So higher mortgage rates cool the housing market down, although we haven't really seen a true cooling yet because inventory has been hit so hard. But lower mortgage rates do the opposite. We saw this in 2020 and 2021. Low mortgage rates mean that people want to go out and buy homes. Everybody wants to buy a home when mortgage rates are at 3%, and people are very okay with selling their homes as well, because now they know that they can sell their home, make some money, and go out and buy a big home. And this is where the question is, what is going to be happening with interest rates and mortgage rates in 2024? Now, there's a couple of different things that can impact mortgage rates. One is the Federal Reserve Bank, the other is what's known as Treasuries. And the Federal Reserve Bank has said that they are interested in cutting interest rates. Although they haven't defined exactly how many times they're going to cut interest rates and what they're going to do with interest rates yet, they kind of hint that they want to cut interest rates a few times in 2024. There's no real concrete data as to what they're going to do. But the parts that they're going to look at are inflation and the economy and all these other things. And if inflation kind of goes down like this, then yeah, we could see some interest rate cuts in 2024, which could push some downward pressure on mortgage rates. Downward pressure on mortgage rates could mean that people can go out and buy a home and hopefully have it be more affordable, but it's also a double-edged sword, because if mortgage rates were cut in half tomorrow, hypothetically, what would happen? You'd see a big influx of buyers into the housing market. And if you see a big influx of buyers into the housing market, now you have a lot of buyers trying to buy these limited amounts of home for sale. And if you have a lot of buyers bidding for homes, now home prices start to go up even more. What does that do? Well, that makes the inflation problem worse, which is what the Federal Reserve Bank has been fighting. But the second issue is, well, your housing affordability starts to get hit again. Now, yeah, you kind of get this benefit of lower mortgage rates, but now you have to borrow more dollars. That's kind of what happened in 2020 and 2021, where many buyers were ignoring home prices because, shoot, it doesn't matter how much the home costs, you can secure a 3% mortgage and your payments are much lower. That was the thinking in 2020 and 2021. So what the Federal Reserve Bank is going to be keeping their eye on, which I'll be talking about here, especially in the coming weeks, is inflation, the economy, and jobs. And if they continues to see this downward trend with inflation while the economy kind of stays strong, then that will give them more fuel to want to cut rates. Now, I'm not saying that's what the Federal Reserve Bank should do, but that's what they said they're going to be keeping an eye on. So you want to pay attention to what's going on with inflation, and if inflation gets closer to that 2% target, which is what the Federal Reserve Bank wants, then that could give the Federal Reserve Bank ammunition to start cutting interest rates. But the second part to this equation, when it comes to mortgage rates, are what are called Treasury yields. And this one gets a little bit technical, so stick with me because it's very important to understand. because a treasury is a loan made to the United States government. And if you're lending money to the United States government, it is considered a risk-free investment. The reason being, the United States government always pays their bills. And even if they don't have money to pay their bills, they can just print some money and pay their bills off. So because the United States government kind of has this ability to always pay their bills, it is considered a risk-free investment. So now, if you have the ability to lend money to the United States or lend money to your broke cousin Bunty to buy a home, who do you think would have to pay you more money in order to borrow your money? Well, if you think about risk versus return, higher risk would need higher returns. Your broke cousin Bunty to buy a home is a bigger risk than lending your money to the United States government. So if the United States government is paying you higher returns, your broke cousin Bunty better pay you even higher returns. And that's why you want to understand treasury yields, because treasury yields can impact mortgage rates pretty significantly. And part of the reason why we've seen mortgage rates fall from almost 8% in the end of 2023 to the 6.5% to 7% area where we are today has to do with treasury yields. The Federal Reserve Bank hasn't cut interest rates recently at all, but we've seen mortgage rates fall, and that has to do with treasury yields. So what impacts treasury yields? Well, this has to do with investor sentiment, investors' thoughts, investor confidence about the dollar and our economy. And when investors are worried about inflation, they're going to demand the government pay them more money. How do they do that? Well, they just don't buy treasuries, because now it becomes supply and demand. If the government is not getting enough money, if they're not getting enough lending, then they're going to have to increase how much money they pay out to incentivize more investors to give them more money. So if the government now is trying to incentivize investors, they will increase their yields. If they increase their yields, now the government is paying out higher interest rates. That means treasury yields are higher, which means now the bank has to make a decision. Are they going to charge you, a random guy on YouTube, less money than they would get from the government? No. The government is a risk-free return. You don't have a money printer to always pay your bills. The government does. So if the government is paying out higher yields, you can expect your mortgage rates to jump higher as well. And that's why you want to understand now how treasury yields play a factor into mortgage yields as well, because mortgage rates are going to play a big part in the housing market in 2024. And that plays a big part with investor confidence and thoughts about the economy. And in order to understand that, that's where you want to pay attention to things like consumer spending. Are Americans going to run out of money in 2024? Are Americans going to run out of the ability to keep spending money on their credit cards? Because there is a limit to how much money Americans can spend. If you keep spending more money than what you're bringing in, eventually you're going to hit a breaking point. And if that happens and the economy starts to slow and people get more worried about the economy, well, that could impact treasury yields, which could impact mortgage rates. And that's separate from what the Federal Reserve Bank is doing. And both of these things are going to impact the housing market, because one of the biggest impacts on the housing market, beyond just supply of homes, has to do with mortgage rates, because that impacts how much money somebody has to pay to buy a home. And if you run a store, discounts can bring more people in, and higher prices can keep people out. It's the same way in the housing market, and those discounts can be created through discounts in the mortgage market. And that's why it's important for you to understand this, especially if you are thinking about buying a home, especially if you're thinking about selling a home, especially if you want to be a real estate investor. But even if you're not, it's good to pay attention that we understand what's going on in the economic system. And again, if you want to learn more about how you can work to build wealth this year, 2024, check me out or check us out at the Wealth Building Workshop that I'm hosting on February 6th live.